So hi everyone. We have already seen a lot of volatility in our Indian markets of late. We have seen a correction of almost 1500 points from the higher levels, and we have seen that the correction has come in the sector which had given uh, quite good results also. For example, banking. So in banking, we had the last 2 quarters really very good, where the profitability came good, and then only we saw the correction. And that is how the market is, because some triggers are required when such kind of profit booking comes. So we saw some domestic news flow coming in, and which impacted actually that particular segment. But again, we believe going forward, the market trajectory will be the same, that it will pick up from the earnings only, and those stocks which have come down, they will again start performing. So how we have structured our today's discussion, that we will have initial discussion on the immediate triggers which have come from the budget. Then we will move towards the themes for 2023. We will also have certain data points where we can see how the growth is coming in 2023 when we compare with the pre-pandemic levels. And lately we have brought in for you some stocks which we believe can outperform in the current context of the market. So when you see from the budget perspective, yes, the Capex announcement was something that I think surpassed the market expectations. I don't think market was expecting 3.3% of GDP, or market was expecting 10 lakh crore of Capex, which actually came. And that is where the Capex beneficiaries are seeing a good move actually right now. And this is the irony of Indian market, that we have a very selective quality companies in the infrastructure space. And that is the reason that sometimes we see their price to earning is getting higher. But when your order book is moving up by 93% or 90% year on year, and the earnings are seeing coming better, then the price to earning, then it gets adjusted over the period of time again. So that is how the cyclical moves are in the market. And that is what we are seeing, that after this Capex announcement by the government, how certain sectors have started performing. And if you bifurcate the Capex, the three major segments of railways, roads, and defense have seen the allocation. We had major allocation in terms of percentage. If you see, it is in railways, which was almost 50%. So this has been one of the key focus of the government. Government wants to reduce the logistic cost from 14% to 8%. And that also is leading to a lot of announcements towards the Capex in railways and some other related themes. Roads also has seen 25% of jump, and the defense around 8.4% of jump. So we have seen the government focus towards the border roads has also been there now this time. And this we have already seen the announcements are coming in the northeastern part. We saw close to 900 crores of border roads being announced by Mr. Singh. And then this is going to happen actually across the periphery towards China, where the border roads now will be in construction. In railways, we have seen the companies which are linked to the Capex, like Siemens, like ABB. They have already started performing really good. In defense, there were 90% of the companies are PSU companies. And we had seen that these companies were performing really good before, but after the announcement of 8.4%, it looked like it was a little disappointing for them. So those companies had come down. But we believe that because the government focus is more towards border roads also, that allocation was already given actually separately. So MSCI is India's, if you look at the premium of India over the emerging markets, because this has been the talk of the town, that India is very expensive and our valuations over the emerging markets are very high. So you can see how it moved up previously, and now it is coming down. So the premium actually, which moved to almost 100% also, Now it has come down in the vicinity of 64-65%. And why it has happened? Because we have been corrected, and Chinese market, which was one of the major entity in the bucket of emerging markets, in fact the top contender there in terms of weight, that had moved up by more than 50% since the month of October. And that is where actually the premium of India over emerging market has declined. So that means the expensiveness of India is reducing, which is making it more attractive now. And our own valuations also had come below the 5-year average price to earning, which was 18.5, and we declined towards 17.5 recently. And that makes us a good proposition actually now for investment. So if you see, there are certain areas in 2023 where India is shining over the pre-pandemic period. The GST collections are 54% higher in Jan 2023 when we look at and compare from December 2019. The real corporate revenue growth is 6.1% in quarter ending December 2022 versus 3.4% in 2019. The credit growth is 16.5%. The non-food credit growth of the banks in Jan 2023. And if you remember, it was 8%. In fact, in 2021, it had declined to 5% also. PMI manufacturing has picked up because of focus on manufacturing in India and because of China Plus One also, that some of the orders are coming in now. 56.3 it has moved to in the recent period. Vis-a-vis 51.7 we saw it in 2019. So this is also a major push towards manufacturing, which is coming now and which is clearly seen in these numbers. PMI services has also picked up. It was 15.7 and now it has moved to 57.4. So there are many areas which were impacted because of pandemic also, but this is a pre-pandemic number. So in the pandemic, this had further deteriorated, but now it has bounced back really nicely. Passenger vehicle sales growth is now around 9%, and it was negative when we look at 2019-20 period. It was minus 15%. So there was a slowdown. We were coming out. If you remember 2018, when the US-China war was there, a trade war was there, and that impacted, the global economies, and the slowdown was clearly evident. So we had a passenger vehicle sales growth actually negative. Consumer non-durable production is at 1% now, which was minus 1.8%. Household financial savings now are at 8.3% of GDP, which was 7.9%. If you look at the job index, which is declared or shown by Naukri, it is showing a growth of 22.7% in calendar year 2022 when we compare with the calendar year 2019, when it was 10.4%. Industry credit growth, if you see right now, so that is also picking up. We saw the overall growth also, and this number also is picking up. Real estate sales is at 15.6% versus it was negative in 2019, December 2019. In fact, the new launches also have seen a growth of 41%, and it was minus 30% in 2019. If you see the market share of goods export is 10 bips higher and services is 80 bips higher than the pre-pandemic. And this why I have brought it this because there are talks of slowdown in the outside world. There are talks of export coming down. In fact, yes, our merchandise export has been ahead in the recent period because of this slowdown. But even then, you can see the numbers. If you see our merchandise export from 2012 till 2020, it was $300 billion. And then it moved to $420 billion. So there was a structural move in export. And now because of this slowdown, it is coming down. But even then, it has moved substantially by 120 or $110 billion. So even if it slows down by $50-60 billion, it will remain higher. And that is very clearly seen here also. So these are few themes that we believe are going to give money if somebody can focus on picking stocks based on these themes. For example, electric vehicles trend, we can identify those companies who are at the front foot of coming out with the EVs going forward. Mahindra in our portfolio, when we picked the stock at 600 rupees, so that time they were talking about coming out with an EV and focusing on SUV. You have clearly seen that now Mahindra, how they have started performing. So they got doubled, but still their EV traction is increasing. 30% of SUVs will be EVs. Even Maruti now, which has come down to good valuation levels, they are talking about coming out with 7 EVs actually by 2030. So they are opening a plant in Gujarat. They lost the market share even in the SUV segment. So that is how the things are picking up. There are vendor companies also which are linked to these companies. There are battery companies also. So you need to identify your picks now based on this theme. Fossil fuel alternatives. So yes, EV is one of the theme, but simultaneously ethanol. I think this is a story which will continue to remain there. We need more and more ethanol for blending with fossil fuels. And right now we have reached to 8-9%. And we are going to be there at 20% now by 2025-26. And that is where there is more ethanol requirement. The sugar companies will again come into focus because a major ethanol is taken out from the sugarcane juice. So that is one thing that is going to be played actually going forward. Then you have green hydrogen Capex. Very few players are there actually right now in this Capex. And then the solar. So solar, you are already seeing the PLI being given actually to some companies. Who will come out with the module of the solar modules. So whether it is some companies like Tata Power, etc., who are looking to have this, they will get benefit of the manufacturing of solar modules in India, because maximum is coming from China in terms of this particular requirement. So that is what the government wants to have an alternative. Government infra spending. So we saw the Capex, a good Capex continuously for the last 2-3 years now. And that is going to benefit many companies now on the ground. You are seeing that some of the new sectors are emerging, which were not performing before. And that is where our focus should be. In fact, government spending continuously will lead to more private Capex also going forward. Cement, metals, chemicals, those companies have already announced where capacity utilization has gone higher. So that is how the things are attached. So this is a big theme actually, infra spending, which is being played out in the market now and which is bringing in or likely to bring in a lot of FDIs into our markets. Credit growth in banks. We have already seen a good move from 5% in 2021 to now, which is around 16-17%. And certain banks are definitely a beneficiary of this. PSU banks also are coming up. In fact, if you see the last quarter profitability, it was 65,000 crores. The overall banks in the previous quarters, last to last quarter, it came to around 58,000 crores. So the profitability of the banking system is improving. The rural distress, which has been there because of inflation, this segment has been impacted. FMCG companies, again and again, they are talking about that the down trading is happening. The premium products are not being sold. So if inflation starts dipping in more, you will start seeing that segment bottoming out. We have to see it going forward. Domestic healthcare. So rather than focusing more on pharma, I think domestic healthcare is one segment where government is also focused. And hospitals, which is unorganized to organized move, opening up of more hospitals. I think that is what can be a focus going forward now from the government. A structural shift in defense spending. We have clearly seen that now in the budgets, the defense spending has been one of the priority. The companies are emerging now. Mostly are PSUs, but private companies are also coming in. And I think that is where it is getting a very attractive stage where our sense is the foreign money also will start coming in now in this segment. 5G, this is a big opportunity. We are all getting data dependent now. Even if we are working from home or anything, the data speed has to be good. 5G is going to be a revolution there. And we don't know how many industries are going to use it in whatever way. So this is a new opening up now with the 5G launch, which will benefit not only telecom, but other industries also. Consumer spending in luxury segment, this has been there because our per capita GDP has moved to $2,400. Despite our GDP at around 5th place or 6th place, we are still much lower in terms of per capita GDP that we need to understand. So the manufacturing push which is being given now, it's definitely going to help. But there are segments which are at $2,800, $3,500. I think those segments are looking to buy the luxury segments more and more. And that is what the trend is being very clearly seen in the markets. China opening up, I think this is again a big theme because China is opening up. The COVID zero policy has gone off. And now it is possible that the metal prices can also start participating. So metal companies can be one of the key beneficiaries of this move. So this is what our idea is for the themes of 2023. If you see the trend in passenger vehicles, it is improving now. And the two-wheelers also has started picking up. In fact, in Maruti, we saw that the rural space also in the passenger vehicle has shown a buoyancy in the recent period, which is a good sign. Naukri job index, now you are seeing that in the IT space, it is lower, but the non-IT is creating the jobs now. So it is to some extent getting compensated actually with the non-IT sector jobs. These are the high frequency indicators where you have the GST collections, which is picking up. You have the rail freight, which is picking up. You have vehicle registrations, which had come down, but we have seen now it is picking up. We have the PV passenger vehicle sales numbers. You have seen how it has moved up in the recent period. The requirement of power is continuously rising. The e-way bills are up. The exports actually have seen a decline in the recent period that we all understand. And this is how the two-wheeler sales are. So the overall scenario is building up that most of the high-frequency indicators are showing sign of revival. Domestic-oriented kind of thoughts are definitely looking very positive. And if the passenger vehicle sales is one signal, then I think the consumer spending, discretionary spending, the start of this can be a good sign. So there can be challenges also going forward if the monsoon is not coming good. Then how the broader market buying, will happen, which is already lower. So that is what the challenge is. We have the state elections, and we know that in the election years, some kind of money goes into the hand of the public, and that also leads to some kind of revival in the consumer spending. So let's come to some stocks now, which we believe can outperform. To start with, we believe SBI, because PSU banks, generally, we always used to buy the private banks, but the trend is changing now. The trend is changing because the profitability of the banking system has come better. We have seen the ROA of SBI actually has gone beyond 1%. The last 2 consecutive quarters, the return on assets actually is coming above 1%. It is 0.87% for the 9-month period of financial year 23. So healthy loan growth, margin expansion, stronger than expected treasury income, and asset quality improvement. I think they are the key positives for the bank now. So we have raised our earnings by around 2% for financial year 23. And we believe that its target of achieving 1% for the whole financial year 24 is there on the cards now. And the ROE of around 19% can be seen. And that is where the stock will remain in momentum. The loan book is already reaching now close to 33 lakh crores. If you see SKF, these are the bearing companies. Very few bearing companies we have. So they are all foreign owned companies. and the promoter, corporate governance issues are not there. That is one of the prime positive. And this is the leading bearing manufacturer, SKF, and it is known for its deep groove ball bearings, and it has a presence across the industrial and auto sector. SKF actually has a debt-free balance sheet. I think this is one of the biggest positive you can attach to it. And it is, it has consistent ROC and ROICs in upwards of almost 20%. And and recently they have got the approval, of Class C and Class K bearing segment from the railways. And as I discussed, railway is going to be one of the biggest focus for Capex. And that is where this company can again come back and start participating. The numbers can be good. And they have already made strides towards R&D innovations, I think, which is definitely very good for them. So the recovery in the CV cycle, the upcoming e-market and commencement of DFC, I think should augur well for SKF. Bharat Forge, this is another one which was consolidating for the last, if you look at 8 years, around 700, 800, or that was below 800. Actually, it was consolidating for the last 8 years. Now, this company has set up the businesses 10 years before it set up the defense business in 2012. It set up the EV components business in 2016. And it also came in the same year in the aerospace, in the light weighing also in 2018. So they have incurred a capex of almost 45 billion rupees or 11 billion rupees in certain segments here. So the company is shaping up good because they had an exposure for Class 8 trucks also outside. And that can be a dampener also sometimes because the outside world is still uncertain. But the positive is that they are developing really good from the defense part and from the EV part. So that is going to be the major kick. In the defense, already they have secured 600 crores of orders, and the total order book in this domain is pegged at around 1950 crores. Bharat Forge's vision for 2030 is to consolidate, take the revenues to around 15%. When I look from 2022 to 30%, or 2022 to 2030. So there is a consistency they want to bring in terms of revenues. So that is what the CAGR they are talking about. And they want to take the EBITDA margins actually in excess of 20%. So if after so much of consolidation, if the company is focusing on some growth areas and looking to have a consistency in revenues with the higher margins, I think the market will give it value, and slowly this company can start giving you a better return. So return ratios also, I think, can expand by 5% in this company, and it can be also above 20%. Dividend payout ratio is around 30% of this company. So that is another thing that one can look at. So ITC, this is another one which was a sleeping giant, you can say, from 2012-13 till the whole last decade. It could not perform, and the volume growth in cigarettes also somehow was missing. But we have seen that the volume growth in cigarette, because cigarette is the main business of ITC. Yes, it has other businesses like hotels, paper, FMCG, which are growing good, but ultimately your bottom line, the margins are much better in cigarettes. So your bottom line is made from cigarettes and majorly. So they have seen a growth over there. We were expecting a revenue growth of around 12%. It has come to 16%. And on a 3-year CAGR basis, if you see, the cigarette volume growth has accelerated from 5.4% in second quarter to 6.4% in third quarter. This is on 3-year CAGR basis. I think that is where the stock is performing. And the tax also in this budget was a lower, which was hardly around 2-3%. So that also gave a lot of relief to the stock, and it started performing. FMCG is doing good. Staples, biscuits, noodles. There we have seen the growth there. And we believe that the earnings of the company, which have already been, upgraded by almost 4% for financial year 23, they are going to be upgraded further by 3% or 4% for financial year 24 and financial year 25. So that is where I think this is a good stock and which is getting re-rated now. And that is what the traction is clearly seen in the stock. AIA Engineering from the mid-cap space. This is a stock because why we like this kind of themes, because we like the stocks which are beneficiary of a Capex which is being done by an OEM. So for example, you look at the cement companies. In cement companies, there is very high Capex which is going on, right? ACC Ambuja, they talk about moving from 70 million ton to 140 million ton, Ultratech Cement from 113 to 160 million ton. When you are doing so much of Capex, then sometimes your supply CAGR is higher than the demand CAGR, which is seen in cement. Like it was 13-14% supply CAGR, but the demand actually was coming around 9%. So that is why the stocks have gone for consolidation. Then how to play the cement Capex story? Then the one way is you look at the companies which are material provider to cement. So this company, AIA Engineering is one of them, which is catering to all the major players in cement, along with mining and other utilities. So that is the benefit that these B2B companies are getting. It has a strong balance sheet and it has double-digit return ratios. And this is a manufacturer of high chrome mill internal products used by cement, mining, utility industries. So it serves both replacement as well as new capacity demand from these industries. And their products are basically popular with the name brand of Vega in the outside markets. So they have presence in 75 countries actually outside. So impeccable track record, results are coming really good. And that is why we believe that such kind of companies can start performing really better, which are direct beneficiary of the Capex in India. Tata Steel. Tata Steel is still available at a much better valuations. You compare with JSW Steel, which has gone to life highs. Tata Steel, which is going through the internal mergers and all, is still available at a lower price. And we believe that what is happening now, if you see in China, the PMI numbers are coming good, which has come good moved up from 50.1 to 52.6. And this is a sharp move in China after the reopening up, that the PMI actually has moved up. And if you see the steel prices in China, they are up by 24%. And that is where the domestic steel prices in India, they are also up by 5,500, rupees per ton. So it is 61,000 rupees per ton now, the price of steel. So the steel prices are little going up. I think this is a trend which can take Tata Steel also along with it. The stock can start participating now. The EBITDA per ton of the company is likely to improve actually going forward in both domestic as well as the European market. So I think that is a kick we have for the stock now, which is available at relatively much better valuations when the internal accruals from the business are also much better. Apollo Tyre from the auto ancillary space, because I think auto ancillary space is also one which will come into focus now. Yes, we understand the fact that if you are supplying more outside world, because outside world is in a slowdown, that you can be impacted. So Apollo Tyre actually, because the raw metal prices have also come down, and Apollo Tyre was working in Hungary. They had operations in Hungary, and Hungary had no problem in terms of the energy prices actually, because they were very closely linked with Russia. So from that front, the company was not impacted. They have a 30% market share in the truck and bus segment and 20% in the passenger vehicle segment. And if you see the EBITDA margins of this company, they are looking in excess of 15% now. The ROCE of around 13-15%. The net debt to EBITDA is likely to come down now below 2x, which was a little higher actually before. So the target of the company is to achieve $5 billion revenues by financial year 26. So that is what is building up now in the stock. And the raw material price decline, crude price decline, can help it to achieve this EBITDA target, what they are looking for in excess of 15%. So lastly, we have a PVR. I think from the consumer discretionary perspective, this is one segment, multiplexes. It's a different feeling going to multiplexes in India for the family, and I think it is not going to stop. Whatever OTT we can talk about, but going to theater and watching movie with a family, the people go for experiment. And recently, there is the food and beverages, whatever. There was a feeling that the people can bring from outside, but there is a ban now on it by the regulator. I think this is again positive for these companies. It is going to be merged with Inox going forward. 150, 200 screens after the merger, they are going to come out every year. I think there is no competition to them, and they will have a monopoly market. And in that case, our sense is that this company revenues definitely are going to grow. We have to see the trend actually of how the people, how many people are going to come back. That is what the market is looking at. Still, it is 4.5% lower than the pre-pandemic period, but the ticket prices are increased by 14-15%, and that is why the revenue of around 920 crores, which they have, it is now surpassing because of the higher ticket prices. So if the customers or the people actually starts reaching to the same level of pre-pandemic, then I think the stock obviously will start participating. So it has not been participating so far, but I think that is where the quality stocks needs to be picked in. So that is all from our side right now. And you can share your queries on comments now. If you have any query, you can please ask me. So I have got one query actually on the El Nino effect going forward, how it is going to impact the market, because this has been a talk of the town now. So yes, El Nino, we had a 4 years of very good monsoon. FMCG companies previously had performed good, but it can negatively impact those companies now because they are linked with the consumption over there. And it impacts sometimes the crops, the heat waves. We had these kind of waves actually previously in 2009, then 15-16 period. And it did impact. And but the cooling products, that is one segment actually which comes out and performs good. So there can be some participation from those manufacturers of cooling products where the requirement actually can increase. So one way there is some negative for one segment, but simultaneously it's a positive for another segment. I have got another query from the Fed perspective that somebody is asking about how do you see now the US Fed interest rates shaping up going forward. So concessional rates are already up by 60-65 bips now for 2023. People are expecting lower inflation, but if it remains sticky because of geopolitical risk, war is still continued, and the way it has crossed 1 year, it looks like it may take another 1 year or so, because it is moving like a North Korea, South Korea war, which continued for 3 years. So if that happens, the supply side constraints will keep on coming up in between, which will not allow possibly the inflation to come down significantly. So in that case, interest rate cycle we have to see very carefully now. Though earlier the 75 bips of interest rate increase was happening, then 50, now 25. There may be a stop also after the mid of 2023. So yes, the Fed also is looking at the numbers, and then they will take action actually on that. So that's all. I think I have covered the queries, and that's all from my side. And thank you very much. We will meet again in the next edition of Market Outlook from ICICI Securities PMS. Thank you.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.